Hey, what's up, stock compounders? Brad here. So, new podcast out with Mohnish Pabrai, interviewed by Stig at the Investors Podcast. Awesome stuff, guys. This dropped just yesterday. So, as always, I'm going to share my highlights from this latest Q&A with Mohnish Pabrai. The first point that really got me, he's talking about the Dakshana Foundation. And he says the management team at Dakshana is there because they know Dakshana is such a great organization. Okay. And he's talking about how at Dakshana, they don't pay bribes. Okay. They will not pay bribes to make progress with the organization. And this actually creates a lot of problems, creates a lot of delays. It can cost a lot more money to get the things done that they need to get done for the foundation. But the point Pabrai makes here really hits home. He says, we can't cut corners on that culture, the culture at Dakshana Foundation, by paying bribes, okay? They wouldn't be able to retain the quality of people that they have working at that nonprofit. And I think this is an easy point to overlook at any organization, right? It's easy to think, well, if we do it this way, it'll be more efficient. Okay, it may not be the most ethical way to do it, but at the end of the day, we'll just be able to get things done faster. And that can really erode a company culture, that kind of thinking. So, this is something I've been thinking a lot about lately, company culture. How do you assess company culture? What does it mean to have an incredible culture at a company? And I think this little point that Pabrai makes here really speaks to that. Having these core values, that can't be compromised. So I appreciated getting that insight from Mohnish. He's asked, what gives you an advantage in investing? Okay, and Pabrai points out really two things provide an advantage in investing. One, the amount of capital you manage. Okay, the less capital you manage, the greater your advantage. Okay, because you can fish in all ponds when you're managing very small sums of capital. As you move up that chain, manage more and more money, the smaller opportunities, they don't move the needle anymore. Okay, so as investors grow larger and larger, there's always these opportunities in the micro cap, the nano cap space that continue to become available to enterprising new investors who are willing to work hard. So that's the first one, amount of capital you manage. The second one, how many decisions you make. Okay, so every week I do a live stream with Punch Card. Okay? Punch Card is the name of our kind of investing group. There's 5 of us from all over the world. And, that punch card is a concept that Buffett, at least I first heard it from Buffett, where, say in your investing life, you have this punch card with 20 punches. And, throughout your entire investing career, all you're ever going to get are 20 punches. And each time you make a new investment, you've got to punch one of the holes. If you had that, you would think long and hard before making each investment decision. And that really speaks to the second point, how many decisions you make. So Pabrai says the fewer investments you make in a year, the stronger your advantage. Okay, so it's really waiting until you get those high conviction bets. And then putting serious capital behind those bets on the infrequent occasion that they arise, right? That you get that opportunity to swing. He also says, if an investor is making 1 to 3 investments per year versus another investor who's making 10 to 20 investments per year, probably the 1 to 3 will come out ahead. And this is how Pabrai runs his kind of personal retirement account. He makes 1 to 3 bets in that retirement account versus the fund he manages, which he likes to make about 10 bets at around 10%, at cost, getting into those positions. So, part of that is he's managing other people's money. I think it's probably he wants a little bit less volatility because he's managing other people's money. He's not just managing other people's money, he's managing their emotions, right? In some ways, he's managing their futures. And that can be very emotional for people. So he's anticipating that. And I think that's part of why, he's doing 10 bets in the fund. But personally, 1 to 3 bets. So, he thinks that's a huge advantage. And, you see this with Guy Spear. You see it with Charlie Munger. Quarter after quarter of 13F filings, they haven't done anything, right? So, it's very, very important in terms of gaining an advantage to really wait until a compelling opportunity comes along, right? Until you get knocked over the head with a great opportunity. Stig announced in this interview that he made an investment in Pabrai Funds. Okay, Stig, I think he said he's interviewed 300 to 400 fund managers through the Investors Podcast. This is the first time he's actually invested with one of the people that he's interviewed. So, and I think this is the only manager that Stig has personal money with. So that's quite a testament to what he sees in Pabrai and Pabrai Funds. And then Stig asks, how would you go about selecting a fund manager if you had to give maybe 10% of your net worth to another manager to manage for you? What would you be looking for in terms of qualities in that manager that you would trust your money with? And Pabrai mentioned Peter Kaufman, okay, and how Peter Kaufman talked about the 5 aces of investment management. And Pabrai listed a few, but I went and I did a search and I found a tweet from 2018 by the Charlatan. Okay, this isn't something that I could find on the internet. Peter Kaufman doesn't really publish things on the internet. I think he's quite private. He's done 3 talks for Google, but none of them are available on YouTube. For those of you who don't know, Peter Kaufman basically edited Poor Charlie's Almanac. Okay, he compiled Poor Charlie's Almanac, which is all about Charlie Munger's life and his mental models, his approach to investing. So Peter Kaufman, he's been around. He's one of Charlie Munger's good friends. So these are the 5 aces of investment management. 1, total integrity. Okay? Do what you say you're going to do. Number 2, deep fluency in whatever you say you're going to do, right? So you actually have the skill set to do what you say you're going to do. A fee structure that is fair in both directions, right? This is that alignment of incentives, alignment of interest. You're not getting paid to breathe, right? As a fund manager, you get paid when the people you're managing money for make money. For an uncrowded investment space, all right? Is the manager fishing in ponds where there are fish to be caught, or are they fishing, in these very crowded ponds where it's unlikely that they're going to outperform the market? And number 5, a long runway. So is the fund manager early enough in their life where, they can compound your capital for many decades ahead? And Pabrai is certainly in that boat. I think Pabrai is in his 50s. Maybe I could see him managing money for another 30, 40 years or so. So there's definitely a long runway there. In terms of uncrowded investment space, I mean, Pabrai talks about the company he's most bullish on right now, the market that he's most bullish on right now, Turkey, where every investor who doesn't live in Turkey has exited the Turkish market. We'll talk a little bit more about that later. And of course, a fee structure that's fair in both directions. Pabrai cloned Warren Buffett's original Buffett partnership, where there's no fixed fees, and then a 6% performance fee over a 25% performance fee over a 6% hurdle. Okay, so there's very, very good alignment there of incentives. I'm not pitching Pabrai's fund. I don't have any money with Pabrai, but it was very notable to see Stig invest in Pabrai funds. I do respect Stig as an investor. Again, he talks a lot about racists. That's probably the position that Pabrai has talked most about over the last couple of years. And particularly about inflation and how Pabrai sees his investment in this Turkish company, Rasis, in an environment where it's 50% annual inflation. Okay, it's insane, right? We cannot comprehend those numbers here in the U.S. I think the latest numbers that came out were like 7% inflation. So how does that even work? How do you make an investment in a country where the annual rate of inflation is 50% and there's no sign of it slowing down, right? Looking into the horizon. And really what Pabrai gets at here is there are businesses in Turkey where the revenues are in euros, right? They're selling things in euros, and the expenses are in lira, okay, Turkish lira. So it's a fascinating kind of situation to think about when you're generating revenues in this strong currency, right, either US dollars or euros, and your expenses are subject to this incredibly high rate of inflation, okay? So it's fairly intuitive to think about that. And if you look out over time, you see kind of a widening gap between what's coming in and what you're having to pay out because of this escalating inflationary situation that you've got in Turkey. Pabrai says a lot of businesses in Turkey, most businesses in Turkey are not investable because of the high inflation environment. But there's a sliver of businesses in Turkey where the economics work out really well. Okay, there's this situation where most of the revenues are in euros or dollars and the expenses are in Turkish lira. So this got me really curious to do a study on, in which countries has inflation been most out of control, right? I think of Venezuela. I think it's Venezuela that has that, ridiculous dollar bill, like a $1 zillion bill or something like that. You've probably seen other people with this thing that costs a couple bucks on eBay, and it's evidence of how out of hand inflation got in that particular country. And I'm very curious to do a study on where has inflation really gotten out of control in different countries, and have there been examples of businesses that generated most of their revenues outside of that country in countries with a much more stable currency. and where most of the expenses were in that local currency. How did those businesses fare, right? How would those investments have fared? Is there something, the way Pabrai lays it out, it makes sense. But I'm just curious if there's something we're just not seeing here, right? In theory, makes total sense. In practice, does it make sense? And one of the ways that I can think of figuring that out is looking at past situations where inflation is out of hand. And have there been those sliver of businesses in those countries that did very well because they met this same criteria? So that's something I want to look into. Let me know if you've done any study of that yourself. Best way to reach out to me is DMs on Twitter. I respond to all of those. So that's Turkey. Fascinating situation there. He's also asked about China, right? He sold out of Alibaba at the end of last year, and so Stig thought, well, I can probably ask him about Alibaba now because he's sold out. And I think Pabrai is, I know he's talked about this before, how the reason he sold Alibaba, two reasons. One was the tax loss harvest, right? He was able to lock in a loss on that investment to offset some other gains. And he was able to buy Tencent, or he bought Tencent via Proces, which is a holding company in the Netherlands, Amsterdam. So it's kind of a two birds with one stone, right? He got the tax loss harvest, and he was able to buy into what he thought was a better business at a similar discount to intrinsic value. Now, one thing that does give him pause with Tencent is the market cap is in the hundreds of billions of dollars. Okay, it's a very large company. Pabrai has mentioned before, he wants spawners, right? He wants businesses that kind of spin off other businesses, right? Either externally or just internally within kind of the parent company. He wants those at, say, 500 million market cap or less, right? The company that he's really bullish on here, Races, he was able to buy a third of the company at a $20 million market cap. Okay, so very small in the kind of nano cap land. But with Tencent, it's already in the hundreds of billions. So how much more runway, right? This doesn't just apply to investment managers, right? A long runway. It also applies to businesses. And the fact of the matter is, if you look at the largest companies in the world, 2-3 trillion market cap. So Tencent isn't far off from that right now. Say it's, I haven't looked super recently, say it's a $400 billion market cap company. Okay, it's just a 5x away from 2 trillion. So size definitely inhibits runway, right? So that's definitely a strike against Tencent. But I think Pabrai thinks Tencent could be the most valuable business in the world a decade from now. He's said that in a previous talk. So I don't know. Maybe Tencent is a 10x in the next 10 years, possible. But it's definitely a knock against it, how big it is today. And then he's asked about, the Chinese Communist Party regulations against these tech giants in China. He says, what I have seen from Tencent and Alibaba is they are adapting really well to the regulations being rolled out by the CCP, right? These rolling regulations. Regulations that kind of seem to change every couple of months, right? It's a moving target, which must be incredibly frustrating to navigate as a company like Tencent or Alibaba. But they've adapted really well, at least according to Pabrai. He mentions, I think Tencent will shift its focus very heavily away from China, where it doesn't have to navigate regulations that are changing constantly. He says, I don't think one needs to sweat the VIE structure, okay, the variable interest entity structure, that have kept a lot of people away from Chinese tech companies, right? Like Alibaba, for example. I think Terry Smith has talked about this, how he really doesn't like the VIE structure, right? You don't own a stake in the business. You own a stake in this kind of Cayman Islands entity that has, rights to a portion of the earnings of the business. It's kind of a little bit uncomfortable of a structure, right? For people who are used to owning a piece of a business. It's not quite that. But what Pabrai says here, I don't think you need to sweat the VIE structure. If you have a choice, you're better off buying it in Hong Kong. By the way, I'm pretty sure Hong Kong is also the VIE structure. Okay, so there's no real advantage in terms of VIE exposure to buying in Hong Kong. He says, I don't have a concern that the ownership is like quicksand. If investors run into issues, it will be because of the core business. Okay? It will be because Alibaba isn't able to execute, right, on its business model, or Tencent isn't able to execute. It's not going to be because of the structure. So, but along the same lines, if investors are correct about where the core business is in a few years, they'll do fine, right? If they are not right on that, they will pay the price. He also points out recently the Chinese government has been pretty cooperative about sharing data, okay, to enable those U.S. listings to stay active. And that sounds like it surprised Pabrai that the CCP was so willing to work with the SEC, right, U.S. regulators, on those issues. So that's it, guys. Probably the most insightful piece of this talk for me was, Pabrai talking about racist and inflation in Turkey. And that really starts around minute 37. Stig was kind enough to break out these different pieces. You can see here, right at around 45 minutes, Pabrai gets into the inflation situation in Turkey and how he's thinking about that in terms of his investments in Turkey. So if nothing else, watch this 10 minutes starting around minute 45. That was particularly insightful, at least to me, and something I want to test, right? I want to find other examples looking throughout history of how that's worked out for investors when that particular situation has arisen, where those revenues are coming from outside the country and the expenses are paid in the local currency. So that is all I have. Thank you all for watching, and as always, hoping for many more Q&As with Pabrai right around the corner. It's always fun learning from him. So with that, I will see you all in the next one. Take care.